Hey there traders! So today I want to take the theory of Fibonacci that I went through in my previous video and give you 3 tips on how you could integrate it into a strategy. I also have a bonus tip at the end, so stay tuned to see that. Let's get into it. As we talked about previously, Fibonacci works at its very best when the market is trending, and we can use it to identify potential levels of support and/or resistance where the market may come back to. We can then enter the trade to benefit from the continuation of that pattern. If this doesn't sound familiar or you're struggling to keep up, then go check out my previous video, Fibonacci for Beginners, which will be appearing in the top right of your screens right now. The question becomes though, how do you know which level to enter at? You'll be pleased to hear there are a few options, which I will go through. First, it should be noted that the Fibonacci indicator should not be used on its own. It should form part of your initial market analysis. That is, the part at which you are identifying a future point or points where you could potentially enter the market. It would then be used in confluence with other technical indicators to further reinforce that now is a good time to enter the market. So technical indicator number 1 is simply support and resistance lines. So when I trade, part of my initial analysis is to draw what I like to call heavy, medium and light support and resistance lines. The heavy are color-coded red and represent major support and resistance on the monthly chart. The medium are blue and represent support and resistance on the weekly chart. And the light support and resistance lines are black and represent support and resistance on the daily chart. Specifics on how to draw these lines I can create a separate video for. Comment with a specific question you have about drawing these support and resistance lines, and I will answer your questions in the next video. Once these lines are drawn and you have identified a trend and where the price is retracing, you can then add in the Fibonacci indicator as an additional confirming indicator of those support and resistance levels. The Fibonacci levels that match up with the support and resistance levels will be more likely to be points at which price may stall and then reverse, especially if they are heavy or medium support and resistance levels. Technical indicator number 2 is the MACD. The MACD, or Moving Average Convergence Divergence, is one of my favorite indicators because it is so simple to use and used in conjunction with other indicators can be very effective. The MACD is a lagging indicator, which means it should be used as confirmation that price is indeed changing direction. Of course, this means it is great to confirm that if it looks as if price is bouncing off a particular Fibonacci level, it is indeed about to continue in the opposite direction. Of course, this is not always the case, but it is more likely, and therefore it is not just a blip before price actually continues up to the next Fibonacci level. So, once you have drawn your support and resistance levels, identified your trend, identified a retracement, and added in your Fibonacci indicator, add the MACD to the chart. If it looks as though price is bouncing off a particular level, have a look at your MACD level and look for the cross of the 2 lines as further confirmation before entering the trade. Here's a pro tip. Make sure the lines have actually crossed and not just joined. This is a common mistake of novice traders and something the pros actually use to take novices out of the market. Remember, they also know you are looking at these levels and indicators. And finally, we have technical indicator number 3, the RSI. Another one of my favorite indicators because again, it is very easy to use. Once again, this is a lagging indicator and so should be used in the same vein as the MACD as a confirmatory indicator. It can be very effective when used with the MACD as well, because they are predicated on different factors, in which case if they are both showing a positive result, it is more likely to be correct. The RSI shows you when a market is overbought and oversold. The overbought level is set at 70% and the oversold level is set at 30%. If the RSI line goes above the 70% level, it is considered overbought and becomes red, and over the 30% level, it is considered oversold and becomes green. Traders will then often wait for the line to head back across the 30% or 70% lines as confirmation to then enter the trade. However, a lot of the time in a trending market, the RSI line will not reach overbought or oversold levels. In this case, I have found another RSI level to be particularly useful, the mid-level. This is of great importance here. This should be drawn on your RSI indicator at the 50% area. you can see that as the market is in that retracement, it will cross above or below the mid 50% level before price reaches the level it may bounce off. As price begins to reverse, the RSI will again cross back over that 50% level. This is the point at which you could choose to enter a market as further confirmation that price will continue in that direction. And here we have my bonus tip, the pin bar. Now this is a candlestick that a lot of traders look for at support and resistance levels to indicate that buyers or sellers behind the price have run out of steam and price may be about to change direction. The pin bar is unique in the sense that it has a very long tail and a very short body. Traders look for this candle to form at a Fibonacci level to indicate this is the level at which price may reverse. If the retracement you are looking at is bullish, remember you would be looking at a downtrend in this case, then you would be looking for a candlestick with a long tail at the top and a short body at the bottom. If it is a bearish retracement, in which case you would be looking at an uptrend, then you will be looking for a candlestick with a long tail at the bottom and short body towards the top, as indication that the market may be about to reverse. The theory behind these candlesticks is that at the top of a bullish move, buyers pushed the price up, but then sellers took over and pushed the price back down. The short body and long tail shows that sellers overcame buyers and therefore may now be able to further overcome and push buyers out the market, which pushes the price further down. This is the opposite for the bearish move, which remember you are looking at in an uptrend, where sellers managed to push the price down, but only to a certain point, before buyers took over and overran the sellers. Again, this suggests that buyers will continue coming into the market and will further overcome sellers, thereby pushing up the price. Okay guys, there we have it, 3 top tips and 1 bonus tip on how to use Fibonacci retracement in Forex. It is a fantastic tool, but should be used in conjunction with a strategy as well. Of course, you can use it with the indicators that I've just shown you, but I've also put together a 100% free ebook for you called the 3-Step Trading System, which details the basic strategy that I started out with to trade successfully in the markets. Simply go to www.theposhenglishtrader.com/3steps to download that now completely free. Once again, simply type into your browser address bar www.theposhenglishtrader.com/3steps, or simply click on the link in the video description below. To be notified of my next video, make sure you hit that subscribe button and hit like to let me know what you thought of the video. Okay guys, until next time.